Hey guys, it's a market update. Insane volatility over the last day or so. Let's go through this volatility, what it means, and then the larger trade that's happening here, because I think what we're actually trading with Bitcoin is starting to happen. And so it's time to pay attention for sure, because this is potentially the setup for the next 12 months, the usual real bull market for BTC. We're seeing macro change. And when we get the change in, the macro, it's going to be very volatile. Essentially, a lot of uncertainty, people selling, people getting out of trades. That's happening. And it's really important because it's potentially the setup for what's to come, which is the Bitcoin trade, right? Which is liquidity increasing, right? Trying to stimulate growth, currencies getting debased, and that's good for risk assets. Bitcoin is the way to price that. I want to go through all of that in this video. Obviously a really important time because I think we're at the turn, right? It feels like the turn. All of this kind of high inflation, everything's, trying to get drawn down from that, right? Rising interest rates in the States, strong dollar to try and strengthen the dollar and reduce inflation there. It seems to be the opposite of that now, where the next 12 months, the Fed wants to ease, right? And so we're getting that turn. It's really important. So the last day or so, very volatile. We drew down to 48,000, 50,000, something like that. Now, from the very, very pico top of this cycle, which we hit a new all-time high for Bitcoin, right? That was, or is, a 33% drawdown from there. Now, it feels a lot more volatile than that because essentially these last 2 weeks, we actually essentially hit the all-time high again, and we've drawn down 30%. 30% is a big move, right? But nothing's really changed. In fact, we're trading at 56,000 right now, which is where we were trading a couple of weeks ago, like the same price. So all of this volatility, all of the speculation, we're trading at the same price as we were 3 or 4 weeks ago. Like what's the big deal? Of course, the fundamentals have changed a little bit, right? And so when you get a big drawdown like this, you've seen TradFi really get volatile as well. I mean, some of the biggest drawdowns in stock markets, especially in Japan since 1987, right? So yeah, it's a big move. And so people are wondering what are the ramifications? So with drawdowns, what you potentially get is a big drawdown, a recovery. And then from here, you start to see, hey, like who blew up, right? Because when you get big sell-offs like that, potentially trades are unwinding. Now, we know Japan raised interest rates 25 basis points. I'll go through the reasons for that, why I think the reasons for that happened. But essentially, you may get a lot of very, very large traders, right? In the largest traders in the world, banks, bond desks, trading rate differentials between different countries and the interest rates you get from government bonds. These are big trades that can get unwound. And so you get volatility here, right? So in any case, 30% drawdown. If you're trading Bitcoin, you're investing in Bitcoin, you have to understand that a 30% drawdown within a bull market is essentially a 100% guarantee. You can see these are all the previous bull markets, right? And so 30% drawdown happens. Now, obviously, Bitcoin is getting a little bit less volatile than previous bull markets. We've seen that. But in every single previous bull market, not one, but multiple 30% drawdowns. So we just drew down 30%. And what this chart shows us, or this information shows us, is that is, or should be, predictable with 100% certainty. Each and every one, 30% drawdown. You got 1, 2, 3, 4, 5, 6, 7 here, much bigger than that. The previous bull market, right? Much bigger drawdowns. Each of them has a story behind it, but they're actually pretty irrelevant, right? If you're investing and you're exposed to risk assets, these are the things you have to know. Things happen in markets, prices go up and down, right? You have to understand the volatility of the asset you're trading and investing in. 30% drawdown is almost 100% guaranteed. Therefore, you must expect it. You should not be surprised when it comes. And you have to make sure that you can handle that volatility by sizing your portfolio correctly. Or the real way to reduce volatility in Bitcoin is to dollar cost average, right? And so you essentially get a cost for your Bitcoin, which is the cost basis of dollar cost averaging over that time. You can look at the 200-week moving average. That's the cost basis if you're just investing every week or every month or whatever it is. That's your cost basis. Don't think of it one trade. I'm in the trade. I'm trying to make money in a year. It's not going to work with an asset this volatile. You have to reduce volatility by investing over time. That reduces volatility because what you're doing is getting a cost basis which is in line with what the network is producing. And we know that the average rate of return for Bitcoin is around 50 to 60% a year right now. That's what you should be working off. Year time horizons. When you're saying, if I'm investing for 4 years or 8 years, 1 or 2 cycles, then I know that if I'm dollar cost averaging, my cost basis is going to be decent, and I let the growth take care of itself. If you're trading, then obviously this volatility, is something that can stop you out of trades. But in any short-term trade, you have an entry, you have a stop loss, right? And then you just let the trade take care of itself. So volatility is part of Bitcoin. We had a volatile move, but essentially we're just back at prices that we're trading at last week. So volatile markets, we're at the turn. So let's look at some of the more fundamental market structure for the next 12 months, which I think looks pretty decent for risk assets. I want to talk about what the Bitcoin trade actually is, or what I'm in this Bitcoin trade for. And I think it's what most people are as well, especially if you're watching this channel, which is the trade of our generation, which isn't about economic growth. It's about central bank policy. Because let's be honest, since 2008, there's been almost zero real wealth creation in the Western world. None. We are in a huge 20-year recession, essentially, where real wealth creation is basically zero. If there wasn't stimulus, either from the central bank printing money or from the government stimulating from the fiscal side, if that didn't happen, GDP would literally be negative every single year because there's no wealth creation. That is the reality. And so the Bitcoin trade is trading how central banks are trying to keep GDP positive by debasing the currency. It's as simple as that. And we're at the macro turn right now, where over the next 12 months, we could see that take place again. Usually the next 12 months for BTC is very, very positive. But look, we're just going to have to go through volatility. And besides, a 30% drawdown is 100% normal in any case. But it's good to go back to basics of why we're in the trade when you get volatility like this. Nikkei 225 index, the second most volatile day since 1987 was number one. As you can see, 1 year forward, all positive for the market. So after a crash like that, is it a crash? 12%. I mean, it's like a Monday for crypto. You're positive the year after. This is Bitcoin halvings. You can see the decline post halving this year is minus 26%. Same in 2015-17, minus 27%, minus 10% here. But you can see the new highs coming. The monetization of this asset is insane. 15,790, now we're at $73,000 in terms of the highs. So that puts it into perspective. Now, people are talking about a rate cut in September. Well, we basically just got a rate cut because the US, the Japanese and the Chinese central banks clearly, talking to each other. Japan raising interest rates in their market is essentially like a rate cut in the States if you're looking from, the strength of the dollar from that perspective. Because the differentials now, each currency only has value in relation to other currencies. They've strengthened the yen, which essentially weakens the dollar. It's the same as a rate cut. That's what we just had essentially, right? If they cut rates again, that actually widens the difference between the dollar and the yen, which would actually potentially make things a bit worse because the carry trade unwinding would become even worse for, those traders in the carry trade. I don't know how that's going to play out. But in any case, if we're looking at rate cuts or a rate cutting cycle, the S&P, which is, fine, we can just see what's happening. A soft landing, you can see 3 months it's up, 6 months it's up. Hard landings, you can see it goes down. These are real recessions. But like I said, I believe we've been essentially in a recession since 2008. And the only reason we've had positive GDP is because of stimulus. And so I just think it's just different. It's a different scenario now. If you have a crash or a credit event, which you could say maybe we had a crash or a credit event. There's no credit event. Credit actually seems totally fine. Maybe a stock market crash, if you want to call it that. You're up bigly, right? 14%, 20%, 3 and 6 months after. That's for the S&P. Risk assets generally may perform like that. So it's only a hard landing where you get a big drawdown. I don't think they can let those happen anymore because there is just fundamental differences. You're going back to the 80s here. The world is a wildly different place. The West, in terms of demographics and everything, is wildly different. And like I said, I think without stimulus, you would just have negative GDP anyway. And so the entire game and the Bitcoin trade is trading central banks how much they want to debase the currency to make sure that they have positive GDP. If you look at this as well, this is again just another indicator of what the market does after rate cuts. You can see all of the rate cuts right here. You can screenshot this as well, but since the 1980s, 90s, early 2000s, you have recessions, you have bubbles and normalizations. Within the first, after the first cut, within 1 to 3 months, market's not going to move that much. But within 6 to 12 months, the vast majority of the time, you're actually up from there. So there's going to be a panic. There's going to be a recession. We're in a almost 20-year recession. And the only trade now is central bank currency debasement. An important piece of data came out yesterday as well, which is the ISM services, which I think got completely overshadowed by all the yen carry trade blow up stuff. For July, 51.4. Anything above 50 is growth. This is for ISM services, which is the important part for US economic growth, 51.4. But everyone's worried about recession. We've been in one since 2008, right? Almost 20 years. If the US government didn't run a 6% budget deficit, this would literally be in the 30s. If they didn't run a 6% budget deficit, GDP would be negative. So why are you worried about recession? We've been in one for 20 years. The trade is how much do they stimulate to keep GDP positive and these services reports above 50. That is the trade. Will there be a recession? We've got one. The only reason it doesn't come through in the data is because of stimulus. Stimulus is the trade. Bitcoin is the trade. Just want to highlight some on-chain data here as well. I think it's important for where we are that a 30% drawdown, totally normal in a bull market, whatever the cause of that would be. But we can see here that you have to be active here. So this is 90-day market versus realized price. All of these drawdowns, are areas where you have to be active. So either, buy dips or just when you're dollar cost averaging, you're getting these dips as well, right? Because that's where really all the returns come from, especially bear markets. This isn't a bear market for me. The reason it's not a bear market for me is because it's actually the central banks. Like I said, everything is trading the central banks, because if they didn't stimulate, either the central bank or the government, right, from the fiscal side. So either one of those, right, without stimulus, GDP would be negative. Therefore, they stimulate to keep it positive. So the trade really is a central bank. So we've had the hawkishness from central banks. I'm really talking about the Fed here. Had all that hawkishness. They're going into an area where they're probably going to stimulate or be a lot easier over the next 12 months, right? China really wants to get on with it because they've been in a slowdown for a while, and the US can't really ease right now. And so they've done it through Japan, right, with the 25 basis points there, which is a clever thing to do and gives China some room to maneuver. But the US have that still to come. So that's why I think it's a bull market, because it's the central banks telling us their cycle, is the easing cycle that they're in. Bull market, drawdowns in bull markets, not a bear market. A bear market is where the central banks have done all their easing, cut rates, maybe push some money into the system, and everything's high and inflation is high. They have to draw things down. That's a bear market. We're on it in a bear market right now. We're in a bull market where central banks, at least the Fed, going to be easier, I think, over the next 12 months. So drawdowns have to be bought or dollar cost average. Real bull markets is the top of that would be central banks done all of its stimulus and its cut rates. That drives the Bitcoin price up high. That is where to worry. If you want to take profits, if you want to buy less there, then important to do that. So you can see it's the 2017-18 and the 2021-22 bull markets. You can see the hodl waves. Investors are really selling down here. Long-term investors know that that's the top of a cycle. We are not anywhere near that right now. Nowhere near that right now. So no, we're not at the top of a bull market. And no, this isn't a bear market happening. This is a drawdown within a bull market, in my opinion, because a central bank cycle. Central bank cycle isn't going to peak maybe until 2025. And if we do get new all-time highs and the Bitcoin price grows, you should see this coming right down. That's the top of a bull market. That's when to worry. If prices are weak, that's when to take advantage of an asset that has 50 to 60% price growth just because the network is growing. We've seen data then that basically shows after the first rate cut, after a hiking cycle, then you get the first rate cut. A year after that, markets are generally pretty positive. So that's really the least amount of time for a trade, right? So if you're trading now, the odds are that in 12 months, markets will be positive. If markets are positive, then you're probably looking at pretty decent crypto prices, or Bitcoin anyway. But like I said, the Bitcoin trade is really trading central banks and how they try to help with the debt creation process from governments who are having to stimulate and create larger amounts of debt to keep GDP positive, where the free market wants it to be negative. That's the trade. And I think we're going through that right now, that process where in the next 12 months, you typically get the refinancing, government refinancing a lot of the debts. And that means they need easier policy because, like I said, GDP wouldn't be positive without stimulus. Government needs to stimulate. It has debts. It needs to refinance those debts and then pour the stimulus into the economy. On the central bank side, what they try and do is create this boom and bust so that during the bust of a cycle where you have inflation coming down and unemployment going up, that's when they say, look, we need to stimulate a little bit, right? Maybe print some money through the back door, whatever, just to stimulate markets to make sure that we have growth and employment. And so what they're really doing, though, is buying bonds of their government. And that slows down the credit creation process, right? And tries to keep, credit from exploding higher. Because if there's no central bank printing money, then, of course, all of the stimulus has to come from credit creation, which means that you are dumping bonds onto the market. The market can become illiquid, and you can't have an illiquid treasury market, right? It's no good. So we create the boom and busts. In the bust of a cycle, inflation comes down, growth scares out there. Central bank says, maybe we can be a bit easier. But what they have to do is time it well so that they can refinance or have the lowest interest rates when the refinancing wants to take place. Just so happens that within the next 12 months, a lot of debt has to be refinanced. So a lot of debt has to be refinanced within the next 12 months. It would be advantageous to have the economy just quite slow when they need to refinance so the interest rates can be the lowest possible. Like I said, the GDP would be negative naturally anyway. And so essentially, you're having an entirely fabricated cycle by central banks and governments that are doing this. So the cycle is fabricated and we're all worrying about it, which we shouldn't because we know they work on a 4-year cycle. So within the next 12 months, government debt has to be refinanced and they would prefer the lowest possible interest rates, which means they create a cycle of 4 years where there's a drawdown, slightly higher unemployment, which means they can draw interest rates down a little bit for that period where they need to refinance. Just so happens to be a 4-year cycle. Just so happens to be a Bitcoin cycle every 4 years within the next 12 months. You see the black line is the current cycle. 100 days to 400 days after the halving would typically coincide with all-time highs for Bitcoin, where you have the part of the cycle where you get the low and then the stimulus, which drives asset prices higher again. So low interest rates are something that would be very advantageous to help governments essentially create more debt at lower interest rates, refinance previous debt at the lowest possible interest rates, because they have to create this stimulus. Otherwise, GDP would be negative and the fiat system would collapse in on itself. That's the Bitcoin trade. That's the trade that I'm in. That's why I own Bitcoin. It's not a 6-month trade. I think this is a generational trade, like decade plus trade, getting a good cost basis here. But like I said, 30% drawdowns are actually normal and to be expected. 50% drawdowns should definitely be within your radar as well, which would be from the all-time high would be 35,000. Totally within the range of possibilities. But we're trading at 56,000 right now, which, is what we traded at a couple of weeks ago. Not really the end of the world, but certainly you have to expect volatility when we're getting a turn in the macro. If you want to trade on Bybit, the trading system I use, I'll leave a deposit bonus down in the description below. You can click that and get a deposit bonus if you trade on there. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.